Hello, this is the Chart Profit video, approaching an hour and a half into the trading day on Friday 3rd of March. As the market's been progressing higher, we've seen consolidation periods such as this. This actually built out a reasonable controlling price at 23.60, which is now our first level support, the 22-day point of control. Any significant selling that's marked above that level can be effective in the day frame, and the longer time frame can be considered reactive as long as price holds above that point of control support. And that's what we've seen yesterday. We were looking for first sign of weakness in the day frame, as I said back on 21st of February up here. Intraday numbers indicate that when the buyers are active, they are effective, sellers not so. We're looking for the first signs that that dynamic is changing. So yesterday on Thursday we saw intraday active selling. These numbers here all negative, generating a lower value area here, lower than the previous days. So in the short term frame, or what I call the day frame, the intraday selling was effective. In the longer time frame, as long as the market holds above, or the E-mini, holds above 23.60, it's in a strong price location. Significant selling below that level would indicate weakness and the possibility we'll see a sell-off down to the next level of support. Currently though, looking at this live hourly chart of the E-mini March contract, we're holding above that level. There are key support levels on some of the charts which we'll look at in a moment. Something that stood out this week, certainly here in the sentiment numbers, was my version of the Ridex assets ratio, which on Wednesday this week shot up to just above 14.02. That's the second highest in the database. Only have one other reading above 14, so this is an extreme reading. Here's the chart, my version of the Ridex assets ratio. At the bottom here you see an extreme spike, which gave us this extreme reading above 14 on Wednesday as the market gapped higher. Only reading I have apart from that above 14 was back over here in early 2015, although it at that point didn't mark the beginning of a major sell-off. There was actually a sell-off after that. A couple of things about this which may have some bearing on our interpretation. I mean, just let's say up front that a reading that high in the ratio is always something to pay attention to, but it was mainly due to the bear fund assets that I follow falling about 20% on Wednesday. As you can see on the chart here, this is extremely low assets in the bear funds that I follow relative to its history, so not many bears in this data. Possibly also worth taking into account is that although there has been a rally in the bull funds, it's not really that extreme. We can see plenty of readings here which have been above the current level of assets in the bull funds. So it's more cutting positions because of I believe the investors are on the wrong side, i.e. the bear funds, rather than a massive inflow into the bullish funds. The other extreme sentiment reading we saw this week, definitely worthy of note, is the bulls percentage here in the Investors Intelligence poll. That went higher to 63.1. Believe it or not, that's the highest level of bulls percentage since 1987. That's an extreme reading by any standards, and we can certainly say the newsletter writers are extremely bullish. Possibly, as a contrarian indicator, this is a warning. Also this week in the active money managers current equity exposure, we call it the exposure index, that rose to above 102, above 100 indicating leveraged long positions in the average active money manager. Again, an extremely high reading. I've marked on the screen here these dashed blue lines where the exposure index has previously printed above 100 or close to it, and although the last two occurrences meant that the market stalled, just too much enthusiasm, we can see back here and back here in previous years these high readings really didn't have much of an impact. This is a really good indicator when we see extremely low readings tend to mark the bottoms in corrections, at least. Not so effective on the extreme high readings that we're seeing at the moment. We also saw a really high reading the previous week, a week ago, in the Lipper US fund flows data. They reported equity funds, including ETF inflows this week of 7.3 billion, which is a reasonably high number for a single net flow for a week. The 4-week net flow that I follow is currently at 23.9 billion. That's down from the previous week's 30.4 billion, which is a high number. That's the highest since November 2014. So definitely from the charts I've just shown there, you can see that there is some very high readings, bullish readings in this sentiment polls, and from a contrarian point of view, that can be interpreted as investors getting a little too enthusiastic for the market, and often marks the point where, let's say, upside is limited at least. We need to see price and volume confirming any negative interpretations of that data at the moment. What do we have? We have a little bit of selling that we've just looked at. That's the red mark here on the spider at the top from the E-mini S&P. So we've had in the day frame some significant selling. We've just seen the price oscillator at the bottom here, the momentum indicator. Although it's strongly positive, trend up, it's just ticked down. The breadth in the middle here remains supportive, green. We have a green reading because these two indicators on the daily breadth chart are holding above their levels. The net new high is 25, 5-day moving average here holding above 0. Percentage stocks in my New York list that are currently printing above their 50-day moving average remains above 50. So these two indicators combined gives us this green positive breadth reading, and you can see from about this point here in the market that's been the case. One of our key charts is the Russell 2000 ETF, IWM, and as we said before, it's been printing plenty of time here above the support at 136.70, which is the 2-month point of control, possibly a little longer than that now. If we see price printing back below that level, that will be a negative. Obviously you can see from the chart this being the Russell 2000 being a bit of a laggard at the moment. Clearly when compared to the spider, the S&P has basically been on an uptrend for this period, where the Russell's been in a bit of a consolidation. That in itself, Russell 2000 underperforming the large caps, that in itself for many is interpreted as a bit of a negative for the market. I think we just see that relationship ebb and flow. To me, though, if it breaks down below here, that would be significant, below the 2 months. If it's a strong market and it's going to push ahead, we really should see this level now holding. European markets are approaching their close. This is the FTSE 100 holding up really well towards the end of this week. Had a real surge on Wednesday here with the pound losing ground against various currencies, including the dollar. Helps this large cap index, which broke out above the previous peak, and we've not seen much of a retracement from there, so possibly a strong end to the week for the FTSE, and likely the German DAX as well. Bonds have an inverse relationship with the equity markets, and we can see that this week with the T-bond ETF, TLT. You can see what happened on Wednesday. Sharply lower, but actually holding this support that we've identified a way back. The major point of control migrated up from 117 something here up to 119, and we've seen pretty good support at that level, and we're back at it again. So it's kind of not really clear cut at the moment which way bonds are going to go here, simply because they're printing at that level. If we see time being printed below here, put the T-bond ETF in a weak position. So if you are bullish on bonds, you really want to see this level hold. That's what we're hoping for. Discuss these charts each day in the pre-open, including this. This is GLD, the gold ETF. If we look at this low to this high, this important low to this high, we're watching the halfway point here, and we broke above that. There was some resistance. We broke above it in January, and GLD has held above that level, that important, what is now support, since then. There's some real weakness this week, however, following a probe just briefly above 119.84, which we know is the major point of control, and has not shifted. There's been no real change in the controlling, or the levels of the controlling prices. So this remains 119.84, and we saw that rejection from that probe, so we're kind of in no man's land here. If you're a gold bull, you'd want to see this halfway point hold and then possibly a higher low above that level. In fact, the dollar has been rallying over the last few days, has not helped the case here. Before we look at the dollar, let's look at oil. This is the oil fund ETF, USO, and it continues. We said it's getting to be a really boring chart. It's continuing to oscillate along this range centered around 1144, which is the major point of control. A little chance of that migrating with that kind of price action so close to it. Probably be helpful for equities if we could see some time printing back above that level. Currently we're in a weaker price location, but it's been oscillating for weeks here. Just switch to a weekly chart, just trying to get some perspective on the larger time frame. The oscillator at the top here, with the week close today, could possibly just turn down again here if we see subsequent weakness playing out on this chart. Wouldn't help the case for the risk on point of view. Okay, the dollar, this is the dollar index. Across this trading range here, I'm talking about the big picture since November, from this top to this low, we've marked the halfway point. We had resistance here and here, and we've broken above it, which puts the dollar index in a stronger price location as long as it holds that level, which is 101. Sorry, it's above that. The halfway point is just above 101.5, and the 6 month a little below that at this level here, which is 101. Unless that point of control migrates higher, which it could, you'd want to see the dollar index holding that level, at least to maintain a strong price location, preferably above that halfway point. Currently I'm seeing the Forex charts, which I'll go through now, kind of lining up in favor in favor of dollar strength. So currently we have the British pound here has broken below this support, which is the half range from here to here, but more importantly below its 15-month point of control at 124.78. So this is weak price location for the pound dollar chart, which has not had a good week. Euro FX chart as well, below its 7-month here and below its halfway point off this important low. So again, weak price location, strong for the dollar here. And the dollar yen, I'll zoom in a second. The dollar looking stronger here at the end of this week. The halfway point from this important high to this low in the middle of last year comes in here, 112.47, currently printing above that. Chart is also printing above 113.61, which is the 4-month point of control. So again, the dollar here in a stronger position. Finally, the Aussie dollar back below, attempted up here to consolidate above its major. I said we'd be looking for that kind of pattern, a higher low, and we didn't get it. We're now back below the major and the 4-year in a weak price location, so again strong for the dollar. So they're all lining up here, and we need to monitor these relationships, the dollar being a real focus, as it always is. We've got an hourly chart going back through the start of last month. We've got the spider in black, dollar index in red. These correlations have got a nasty habit of breaking down as soon as you assume anything, but currently looks as though strength in the dollar is being taken pretty positively for equities. So we don't want to see the dollar weakening in those charts we just looked at. Okay, that concludes. Once again, I wish you a good weekend and thank you for watching.